All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, my good friend Mike Patton, who's just down the street. We're going to be catching up later this afternoon. Looking forward to seeing you, my friend.
Absolutely, Sip. It's been too long, man. So
I
yeah,
know, I know. Riding through the city today, it's cold, it's rainy. I'm
I
like, oh
know
my God, I've missed this for
you
so
missed
long.
last week was so beautiful. It's so sad. I'm sorry, man.
And with that, the word on the street today is retail sales, right?
Yeah,
Starting off
wow.
with Walmart yesterday, Target today, and the entire sector in general. So I'm curious as to what you're seeing, what the AI is seeing, and what some of your customers are saying.
All right, good point. So let's just start off right from the top. I'm looking at on the Madison platform the broad view of the market. Currently, the SPX. Let me refresh that. Down 3.05% for the day. We've got sectors in the red across the board. Everything's selling off. But the big reason why is when I saw that Walmart had bad earnings results. I mean, they missed expectations. The markets automatically assumed that other retailers were going to get hit the same. In fact, a lot of companies that already reported earnings, like Coca-Cola, Pepsi, General Mills, all these are brands you're going to see all over Walmart. Like if you go to any Walmart, any Target, you're going to see these brands, right? Those stocks start to slump yesterday once it was clear what happened to Walmart, because it's logical. If Walmart's suffering and all they are is a big conveyor belt of all sorts of retail goods and services that pass through them, if they're suffering, then the economy is under some serious pressure. It doesn't surprise me the markets came down, and the severity that we're seeing now is crazy. We're going to go over Target in a little bit, but we're seeing declines that we haven't seen in a long, long time. And I don't think it's over. I think we've got so many headwinds right now, and I also believe that looking at the general economic picture around the globe, a lot of stuff that we did during the height of the COVID situation, all this money being created, money being thrown out. Yeah, it was good for a while. The binge was good. But now it's time for everyone to kind of sober up. We're all getting hung over looking at the picture that it wasn't sustainable. Unless they kept throwing out that money, there's no way that this was sustainable. So it was just a matter of time. And it seems like it's all hitting at exactly the worst time, where you got global conflicts, you got COVID issues, you have interest rates coming up. I mean, everything's just hitting all at once. So if consumers aren't buying, if they're not spending, that's a really bad sign. That's a hugely bad sign.
Yeah, and last week the big news was inflation. This week the news is retail sales, and the
Right.
two kind of go together when you start to talk about the consumer. And I feel like maybe we should go straight into Target because it
Sure.
was the earnings report of the morning,
Hmm.
and I think the big headline there is they're down like over 25%, right?
Yes.
The largest decline since Black Friday 1987.
Right. Yeah.
Really that's what's happening today.
Exactly. So this is shocking. Not surprising, but shocking. So obviously, I discussed this with so for our platform, our members actually get to access our live broadcast every day, where we go over what's happening in the markets. And one of the things I point out was that if Walmart's looking bad, and Amazon was the preemptive, like Amazon was the leader that says, hey, something's not good here, and then Walmart shows the same thing, and now Target. So everything's confirming exactly what Amazon suggested was true in their earnings, and that is that the market's in trouble. We're not seeing consumer spending. So Target down 25%. That is literally the lowest, the biggest drop it's seen in a single day since, you're right, 1987. So this is horrible, horrendous. And when you think about it, is this the sort of stock people would expect to be down 25%? No. Well, Walmart was down over 10% at one point. I mean, this is crazy. So if you're seeing these type of declines in stable, well-established stocks, who knows what's going to happen when we start to look at some of the smaller companies, like what they're going to be suffering. And we're I mean, these numbers just came out, so obviously the earnings just came out. But what's going to be interesting is I'm going to be watching this metric right here, inner circle. One of the best features of the software is that it keeps track of institutional trading activity. It knows if big buyers and sellers what they're doing, right? Now, this number is not as of today, so I just want to be clear about that. This will be updated when we get into the market tomorrow. Because remember, these funds have to file. They have to send out the information to the SEC, so it doesn't happen instantly. They don't send us a tweet and say, "Hey, by the way, we're selling." They don't do that. So basically, we got to find out once the filing occurs. But once it hits the SEC site, the software is going to read it automatically, and it's going to tell us who's doing what. So as of right now, we already saw a bit of a slump in institutional ownership. It was down 2.85%. But once the new filings come in, which are guaranteed to come down, I mean, there's no way a 25% drop is not going to get some people to want to sell, because we know they were selling anyway. There's no way this went down 25% unless some big players were selling. So, in short, we're probably going to see some really negative numbers coming out for institutional activity already before this, before the earnings even hit. Target had 197 um, less buyers. And we're talking about funds like Vanguard, Fidelity, those sort of funds. 269 more sellers. It dropped 8 from the top 10 lists of all these funds out there. Now, insiders like corporate insiders are not a big deal in this company because it's only a small percentage. It's less than 1% insider owned, so that's not really a big deal. But it's 69.64% institutionally owned. So if they're selling, that's a big deal. And this is the pattern we're seeing across the board. Like if I look at Amazon, okay, Amazon's up 1.22%. So that's a little bit confusing because you would think it would be lower, but it's actually up slightly. But if we look at the pattern of trading or of activity, we have 455 more, fewer buyers, 638 more sellers. We do have it in 25 more top tens, but my belief is that this is a safety bet. In other words, if you're looking at the retail sector, you're trying to find the one company that probably can survive better than the others. Amazon's online only, so they don't have to. They have inventory, yes, but they don't have as much overhead to worry about as some other companies do. So compared to a Walmart, I would say Amazon's probably a safer bet, and that's the reason why I believe you have some people moving into that. But that may all change. But I can guarantee, well, almost guarantee, knock on wood, but I can pretty much guarantee that Target is going to see a mass exit of buyers. You will see people that want to buy anyway. They're always the long term guys, but I think that's going to be a negative there. And if we look at Walmart, just kind of rolling through it, Walmart also saw a significant decline. Institutional ownership down 0.34%, 249 fewer buyers, 333 more sellers. It is still in 25 more top tens, but again, I think this is again a safety bet. So chances are Target's not going to be in the top 10. I may be wrong, but my guess is that institutional players are going to look at these numbers and say, yeah, probably not the best stock to put in our top 10. I'm sure they're going to still hold Target. Why not? But I don't think that that's going to be as an attractive buy. One of the things that's critical that we want to keep in mind with institutions is that they tend to follow patterns. So once you have them starting to drop shares, the tendency is that it continues. So if we watch this histogram over time, this blue color histogram in the background, gradually that's going to keep getting lower as more and more institutions start to offload shares. And Target, we're probably going to see a much worse picture than that because obviously it's taking a much bigger hit. So yeah, it's I mean, Sip and everyone listening, it's not looking that good. I have to say that this is probably one of the most brutal, sell-offs we've seen in a while, and it's all coming off of retail, which is usually a really good gauge of the overall economy. So if retail is not doing so well, most likely the rest of the economy is not going to be doing so well either.
Yeah. And so when you look at the color codes, right,
Hmm.
in the top left,
Hmm.
the two bottom greens, right, aren't
Yep.
really reflective yet of today's earnings. Is that correct?
That's mostly correct. Yes. So earnings right now just came out. So right now we don't have all the numbers populated in. So I would say wait until tomorrow, or by the end of the day, it will all be recalculated. But most likely, these numbers are going to go in the negative direction. So valuation will probably stay mostly positive because the stock price is just going to be down. But that doesn't mean that it's necessarily a good buy. So we're going to see a change in analyst estimates. In other words, everything that's came out now. So the software is going to have to tabulate all the things that people are saying. But I can pretty much guarantee when I look at this tomorrow morning, these numbers are going to look radically different than what they do now as far as estimates and targets. And in fact, if we're looking at, well, actually, I'll go over that a little later as far as some targets that have been set for some other for the economy. But in general, we're going to see some negatives coming in for these stocks like Twitter, or sorry, like Walmart, Target, and I did want to mention Twitter. Forget before I forget. Although it's not in that group, there is something I did want to go over with that. Twitter, as we were discussing before, Elon Musk obviously was supposed to buy Twitter. Now he's saying, well, I don't know if I want to do it now because there's a lot of bots, in in Twitter, and he's probably right. In fact, I would say probably there are many, many, many more than they're saying there are, which would mean that they're selling advertising at a price that's inappropriate for the actual number of real contributors and followers there. I saw estimates that some major figures, I'm not going to name them by name, but some major political and other figures I've heard have followings that are half what it says they are. That's pretty big. So the question right now for Twitter that everyone's asking is this. Let me go to the chart view so we can actually look at it from there. So we had this big jump after the news came out that Elon Musk was looking to buy Twitter. Or actually, no, that was when he took a 9%. Was it 9% or 11%? It was 9% stake, I think, in Twitter. Then later on, he said, well, I don't know what I'm going to do. Then he said, I'm looking to buy it. And then, of course, we all know what happened. And then now it comes back down. So you and I, of course, we've been talking about this for weeks now. And one of the things that I did point out was that the markets, based on the numbers I was seeing on the options, they weren't suggesting that the traders were convinced this deal was going to go through. And we knew why, because you had all sorts of political hurdles, regulatory hurdles. But now you have this. And once that came out, I think everyone pretty much realized that there's no likelihood that this deal is going to go through. Now the question is being asked is, well, can Elon back out? Because in the clause it does say that he has to pay, I believe, $1 billion if he walks out. Now, can he pay it? Sure. Does he want to? No. But there is a catch there, and he kind of alluded to that. I don't know if he actually explicitly said it, but it's true. If Twitter is guilty of fraud, if they've literally falsified records to present their company as being X, but it's not doing as well as they say, then that is legal cause for him to walk out, right? And there have been merger deals that have fallen through for that exact reason, and the people that walked out were held blameless because that's just a legal requirement. You can't, if you're fraudulent, if you're lying about something, then that undermines the actual purpose of the merger, the logic of the merger, and therefore it makes sense that would be something you can walk away from. So if that proves to be true, and like I said, I do have a strong suspicion that that probably is not far from the truth, that they have much larger amount of bots, fake accounts, for those who don't know what that means, than they claim. I think they said 99% they claim were real, which is unbelievable. Like, no, I don't think any platform in existence has 99% people that are real. So my guess is that this is going to favor Elon legally, and that's going to devastate Twitter. So how far down it will go, I don't know, but I can pretty much guarantee that this is not a good buy. So I would be very cautious about that. Software
So
is
what?
basically.
So what you're saying, Mike, basically is
Mm.
Elon, if he doesn't go through with the deal, owes Twitter $1 billion unless he can prove somehow that they're doing something illegal. And the illegal part is that they're claiming they have X amount of real users when not the situation. And so he
Correct.
just needs to prove
Right.
that the bots, or at least the numbers that they've claimed in their earnings reports or whatever, their
Mhm.
user,
Yep.
and so going back to the stock, right?
Hmm.
That jump up is the Twitter news, is the Elon Musk news, right? So we're
Yep.
basically at the same level prior to that news coming out.
Right.
And the question is, will we kind of go lower? And then Elon will come back and say, all right, well, I don't want to pay 42 or 43 a share. I think you guys are more like 37, 35 a share.
Well, that's what I might expect him to do. In fact, it would be a good tactical move if he does. So if the stock is collapsing, the first thing shareholders, the major shareholders, are going to be thinking is like, man, I need to get out of this thing. So if he comes in, rides in on his horse, and says, "All right, I'll bail you out at a price that no one else is going to give you," okay. I mean, who else is going to buy them out at that point? Now you never know. Maybe some other companies will come out of nowhere and say, "Hey, we want it too." But in short, unless another company or buyer comes along, I would say that yeah, Twitter's probably coming down farther. And if those allegations are proven to be even modestly true, we'll probably see a really sharp decline even farther. And Twitter's not doing so good. I mean, institutions. I mean, look at this. Institutional ownership is down 49.21%. I mean, that's massive. That's if ever there's a clear sign that people have no confidence, that's it. So this stock is getting pushed out the door basically, and unless they can prove themselves, if they come back and they can prove that hey, 99% of our users are real, sure, that stock's going to fly. But keep in mind that I think the markets were already assuming a high level of active users that were actually real. So the price wasn't that high before. So if it comes out if they have fewer than everyone expected, that's even worse, And social media companies live and die by users. If they don't have it, there's no reason to pay for it, to pay for advertising.
Yeah, I
Yeah.
feel like there's a lot of drama around this every day, tweeting or there's news coming out, and
Yep.
that's why we have the Madison Trading House software to kind of help us
Right.
weed through all that information. And what you're saying is things aren't looking good when you look under the hood. Even if there is a white knight riding in to save them, they still have problems. And I think they're
Right.
having even more problems this week with two executives quitting.
Right.
And
Yep.
and it's kind of sad because they could be making money like Facebook does. It's just
Right.
they've had so many, it seems like, internal problems.
Right.
So we'll have to keep an eye on it. Is there a level that you start to get excited to maybe look to get in?
Be honest, this one is way up in the air for me because in theory, there's always a price where people want to buy. But with the way this is developing, the situation is so vague. Like we don't know who's going to be around next round, like who's going to quit, who's going to stick around, whether someone's buying, whether they're not, how many users there are, how many are not. So with that much fog, you can't really pick a price. I mean, the only price that's safe is zero. you know, if I buy it for $1, I'm pretty sure it's worth $1. But if we're looking at any price higher than that, it really does come down to what these numbers really look like. And then also, if someone like Elon comes in to take over Twitter, what's going to be the outcome for the staff? Like, are people going to leave if he comes in? Which I think a lot of people would leave if he comes in. So then, what does that make the makeup of the new company? So I think that was the reason why he said he wanted to take it private, because it would be a lot easier to manage the company without the input and influence of the board of directors. And probably a lot of those board of directors are already sympathetic to the way things have been going so far. So if he's trying to radically change that, that does bring up a lot of questions. So I would steer clear of this stock. I would not buy it at all until the dust really is settled. And so far I've been betting against it, and I've been right. But as a habit, I do tend to bet against Twitter almost every time it's up, just because, generally speaking, almost every time there's good news on Twitter, it's
They
followed
don't
by
make
massively
money. They
bad.
don't look
Yeah,
at that chart down there. Their earnings, they don't make any money.
which is yeah, they're not a very profitable company. They have years they're up, years they're down. So it's not like a Facebook, where if I look at Facebook on this, you would see consistently Facebook's making money over time. Now it's been struggling recently, but if you gave me the choice of, hey, you either buy Facebook or buy Twitter, I'm buying Facebook because at least I think my money's going to be around in a few years.
Another one of my clients has brought up a few times is Pinterest. And Pinterest looks like it might have potential because it does seem like they have their act together on the back end and it's at a reasonable price.
It is improving. So, I mean, they're right about that. If you look at the earnings, I mean, they had some horrible earnings in 19. 2020, everyone was suffering. But then you get to 2021, they actually beat expectations. This year is expected to be about the same as last year, but come 2023, the analysts currently I mean, the system's tracking the analysts, and they're definitely projecting more growth. And if we look at the price projections, 34.38 is where the average analyst believes that the stock's going to be. Down the road, the highest is 60. Yeah, 60 exactly. So I would say that whoever told you that, they're probably right. And you can look at the numbers. I mean, these numbers look good. Sales are up 3.48% on a trailing 12 months, 0.59% up here, 2% up there, 5.8% up there. So, I mean, these numbers are looking good. So, I think that overall, this will be pretty positive. Um,
Yeah, well, so we're getting hit with retail sales are getting hit hard. Social media is getting. What do we have to look forward to then? What is the Madison Trading House software going to shed some light where there might be some opportunities?
all right. Well, yeah, I was definitely going to take a look at that. And I should also mention before I jump into this that if you look at the overall big events that are out there, of course, we have the equity sell off, which is literally triggered by bad earnings from big retailers like Target and Walmart. You got the U.S. pushing for Russian debt default, where they're basically going to pull the door out for this concession they were making to allow Russia to pay their debt. Delay that on the bond payments, but basically Russia owes money, which is every country owes money, and essentially they've denied them the ability to pay in dollars because the assets are frozen. So therefore, there's no way to do it. So the question now legally is, can that be done? And from what I understand, it can't be done that way because then you would have a legal case by Russia to say, hey, well, we can pay the money, we got reserves, but you won't let us use them. So, oh well. So that's gonna be a big deal because my guess is that if that's not played right, that could actually sink the market even more because now you've got a bunch of investors who have these bonds that are now going in. You have a major holder going into default, being forced into default essentially. And for the investor, that's just going to be bad for them. So I don't know how that's going to play out, but it can't be good if it goes that direction. And then you got North Korea with the COVID outbreak. You got Goldman Sachs and Citigroup both cutting GDP forecasts for China based on the lockdown. So we've got a lot of pressure right now. And the reason this all feeds into retail is that if you think about it, where most of the things we get in a retail store come from, they come from China. And if we've got China in trouble, you got a COVID problem, you got GDP being cut there, that's going to hurt us too. So there's no surprise to me that this is happening. And if you pile on top of that these other issues, I mean, yeah, we're going to be under some pressure. So the platform is actually showing us some pretty good insights. So I'm on the main view. If I click this little arrow here at the right, it's going to take me to a exploded view of sectors. I'm looking at the S&P 500, so I got it up here. That's all I'm looking at. But I want you guys to pay attention to this part right here. So I actually have on the right the score. Just ignore this part in the middle for right now. Just look at this part over here. So the score is showing me a chart icon, the inner circle, the valuation and fundamentals. Now, a lot of ETF people, they ask me this all the time. They say, "Man, I wish there was a way for me to analyze an ETF or a sector based upon all the stocks that are in it, but do it individually so I can get a composite score of what the sector is doing based upon what its components are doing." And that's exactly what this does. So when I see green over here for basic materials, what it's saying is that overall, when we look at basic materials for as a sector, most of the companies in basic materials are doing well. They have good, solid fundamentals so far. When we look at valuation, it's showing me yellow, which basically means that overall, the stocks in the S&P that are in the basic materials sector, overall they have a intermediate valuation. They're not low and expensive, but they're not expensive either. They're just in a happy medium. But we are seeing this pattern here for inner circle. Notice that for every sector we're looking at for the S&P, the inner circle's in the red. Every last one of them. And we know what that means. We were just looking at it when we looked at Walmart and Amazon, etc., or Twitter was the last one we looked at. When institutions sell, markets go down because they have all the money. So when you got trillions of dollars of shares being sold as big funds liquidate holdings, whether they're liquidating all together or in part, you get a downward move in the markets. This is the absolute proof that who's in the driving seat. It's the big players, it's the bigger funds. And because they're selling, even if the fundamentals look good, if they're selling, if I keep seeing all these red O's, basically, that's not a good sign. And that's exactly what we're seeing. So there may be some sectors that are going to get to a point where they're at a value, but it's not going to go up. And I can't overstate this enough. You're not going to see a rally in any sector unless big players start buying. Otherwise, no chance. So we need to see these inner circles start to turn green or yellow. At least they're slowing down. So if I see like a yellow here and it's green over there, that's good, but we're not seeing that. But if I look at individual companies within that space, let's go to consumer since we're just talking about that. So if I look at the consumers here, I have personal services. There's only one stock apparently in there for that one, but there it is. It has yellow and has good valuation. Fundamentals are intermediate, so maybe that's a safer stock to get. So if I check out which one that is, it's Rollins Incorporated. I don't know anything about Rollins Incorporated, but there it is. I just discovered a stock that looks like it's doing better than most others in its particular industry. Now, if I look at others, let's look at furnishings. Okay, so there you go. There's Leg Mason, or sorry, Leggett and Platt. Sorry, not Leg Mason, Leggett and Platt. If I said that correctly, but I recognize this company because they do furnishings, and what this is showing me is that they have solid fundamentals, a solid valuation. They're currently neutral. In other words, institutions don't seem to want to sell this stock. They seem okay with it, and the chart is pretty flat. So what this is saying is, if you rebalance your portfolio to where you put more money into something like this stock, most likely your portfolio would suffer less from the overall market decline, right? So if you start to move into the stocks that are not being sold but are being held, that would actually help you tremendously if done with the right timing. And of course, that's what the platform provides. And what it's telling me right now is, as of today, this company is actually improving. It's almost all green. So if I'm looking for a potential buy, something I can get into that's not going to get hit so hard by the overall sell-off, this might be it. Now, it doesn't mean that everyone loves this company. I mean, we have 72 fewer buyers and we have 27 more sellers. Institutional ownership is up 0.52%, but when we look at the numbers, which is what the software is tracking, the bigger numbers of how many shares are being sold or purchased, this one is still looking fairly solid. So this is a good example of how we can use the system, the software, to actually automatically locate stocks within sectors that might be able to perform a little better than others. And I could do that for any sector I want and any industry I want. I can look through it and see which stocks are looking like they're in good shape. But as long as the institutions are selling, as I said before, as long as they're selling, then that sector or that stock is going to be pushed lower. So we have to always keep that in mind. So I would say this is the time where you want to only focus on stocks that look something like, here's Charter, doesn't show the red in the circle. That's the one you want to be more focused on right now. All the others, even if they have good fundamentals, hold off. They'll probably go down lower, and then eventually you'll get a chance to buy in as soon as you start to see those institutions back off from selling. And one last thought, institutions are not going to respond on a whim. They look at information carefully, they study it over time, they have their expectations. So when they move decisively. So if we see that the institutional selling dries up, then that means that we're probably safe. It's probably a good time to start buying. So I would say if the stock's not in the buy yet, wait to that the institutional activity of selling slows down, and that's where you want to start looking for your buys.
Yeah, and this is a fabulous view for definitely that type of analysis that you're talking about. So I'm going to go ahead and drop a link in the chat for anyone that wants to test drive the software for yourself, get inside access, get a demo with a rep at the team. We're going to go ahead and drop that. Feel free to click on that link, sign up. I do have a question on this view, and I'm sure a lot of the viewers do as well.
Hmm.
What's everything in the middle? What are all those numbers, and what's that
Well,
telling us?
well, basically they're just it's basically the same thing as this, but but displayed in a slightly different format. So it would take a while to really detail it, but basically when you look at -4, -2, etc. So the colors here, if you look, these are showing the percent changes. So what it's saying is within the basic materials, this is kind of showing me the spectrum of what's been happening to different stocks. So some are improving, some are not. But in short, once we go into our next when we go into our next podcast, I'll go over this in more detail. But that's basically what it's showing is it's giving me a score of what's happening for the components that are inside of each of these sectors. So it's the same idea. I'm sorry, as the heat map, but the heat map shows it in color. In other words, up here, this legend says that light red is -3% change or more. So this is just showing it to me in color. The other one is showing it to me in actual numbers. It's just saying what the difference is, but it doesn't tell me exactly which stock is which. So therefore, I have to jump into here to kind of know, what's going on with each.
Sure. And then another follow-up question, top left drop down,
Hmm.
right? Do you have different indexes, right, to
Yes.
categorize the sectors, right? So you got the S&P,
Yep.
some of the smaller ones, and
Hmm.
then the other filters are percentage change,
Right.
and then some sophisticated stuff, and then
Yep.
basically the data on a time frame.
Correct. So you can change the view however you want. So I could say, okay, let me sort by, well, let's go over here. It's easier to understand. Let's go by Russell 2000. So now I'm seeing a listing of all stocks in the Russell 2000. I can basically pick and choose based on sectors, and I can see how everything's performing. But again, we keep seeing that consistent pattern that we're seeing those reds in the middle for the inner circle. So we're not seeing, we're not really seeing anything. Oh, there you go. Basic materials in the Dow. Okay, that's one. And there's one exception. Let's see what we got there. That should be what's chem?
Well, that's
So
like that
Dow, yeah, Dow Chemicals. Yep,
energy play we talked about last
there
week.
it is. Dow Chemicals. That's what I figured it was. This has actually been a pretty good performer. So what this is saying is this is a stock that even though the rest of the market's getting sold off, this one's actually holding its water. So it's good to know that. I'm glad you brought this up and asked that question. We'll go over this in more detail in the next one. But we can sort based upon whatever we want, Nasdaq, etc. We can look for stocks, look for sectors that are performing better or worse, and then that way we know which stocks we want to hold on to and which ones we probably don't. So if the institutions are selling, yeah, we probably should be as well because they're going to drive the price down. So rather than kind of hold in there where they're selling, get out, and then come back later when they start to buy and support the price.
Yeah, you're definitely seeing the consistency of the institutional selling there. So
Right.
I'm assuming that over time, we'll want to see some of those start to turn yellow. And then when they really start to take off, green.
Yep.
And the green, you're kind of just waiting till it goes back to yellow.
Basically, yes. That's a good way of thinking of it. So we basically can manage our positions based on color changes. So if I notice that institutions are buying, I know what that means. So of all the things here, the institutional activity is the most important because they're going to drive stocks. The only stocks that don't get driven strongly by institutions are the ones that have very low institutional ownership. So if most of the owners are retail people, then institutional activity doesn't really count as much. Although the institutions will always be more consistent, and that means it's easier to anticipate what they're going to do. So the stocks that they're going to focus on first will be the ones that have the best fundamentals and the best valuation. So if I'm looking at sectors, the most likely candidates for some buying activity would be communication services. We're looking at the Nasdaq 100. So communication services will be the top because it has two greens at the bottom. The second one would be technology. Okay, technology currently has a negative trend technically, but again, if I'm going to look for anything and I'm an institution, sorry, I always forget that this goes off. There you go. If I'm a institution and I'm looking for a buy, I'm going to focus my attention on whatever has the best profile first. So basically, technology is definitely going to be where a lot of money is going to pour into once things start to turn around because these stocks have been beat up the most. Communication services will also be one, but anything that shows a weaker hand will be less likely to be chosen. So industrials will probably not be a top pick. Healthcare, financial services probably won't be top picks. Consumer cyclicals probably won't be the top picks. So the score that we see when we come into that buying that starts to come in at some point, we're going to notice that typically, as long as these scores are still positive on the greens at the valuation, the dollar sign, and the fundamental, the three lines, as long as those are still green, those are going to be the ones that are probably uh, going to get the most attention. That's just the consistent way that institutional trading works. They look for the better values and then they go into them first.
Yeah, I love it. I've been growing more and more of a fan every day since we started working together, and I've
Awesome.
really to log into the software because it does really help you save time. It does help you categorize thoughts, analysis, things like that. And so I encourage everybody to click that link, sign up for the demo, test drive it for yourself, and I think everyone else will love it as well. And
Awesome.
so with that, I do have one kind of question as we go into the close here,
Hmm.
and I've been hearing this term of a bull rally, right? So like
Hmm.
we're down basically about 20% from the recent highs, and a lot of the pundits keep saying that okay, well, we're kind of going to sit at this level for the next couple of months. And so I'm curious as to what your thoughts are on that, and what any of the viewers should be looking forward to the rest of the week going into next week. What are the next things that will be driving the market either down or potentially seeing some of this bull
Well,
bear rally?
whenever you have a sharp sell off, eventually you get a sharp pullback as well. But one thing that I would say is concerning, and the software is pointing this out very clearly, this little graphic down here, let me make it a little larger if I can. Actually, that's not working. Okay. I thought I could
It,
resize the window. But anyway, here's the graphic I'm referring to down here on the left. And what it is, it's tracking stocks that are at 52-week highs or 52-week lows. And the histogram bar that points down is saying how many stocks out of the NYSE are at 1,000, or sorry, at 52-week lows. So on May 12th, we had 1,046. You can see a little box there, 1,046 stocks that were at 52-week lows. And we had four stocks at 52-week highs. Four. Okay. So now we go to May 13th. We had 212 stocks at 52-week lows, 12 stocks at 52-week highs. So it's improving. We go into today, we're at 201 stocks at 52-week lows, 33 at 52-week highs. So we're not really improving from, over the last couple of days. We're kind of stuck in the same place. So what we want to see is that more stocks are moving away from 52-week lows. If we see that and we start to see that growth of 52-week highs, then I would be convinced that we're seeing a recovery bounce. Now, how long it's going to last, that's another story. We don't know. But I would be convinced that that would be a sign that the markets are actually shifting direction. But having said that, um, my personal thoughts are I don't think we're anywhere close to a resolution to the markets coming up. Seeing them stuck in the same range for a while, I could definitely see that. But my concerns are that when you think about the movement we had today, that was catalyzed by new information that just came out. So all the downtrends we saw before was based on everything before, and the markets were expecting that Target, Walmart, et cetera, they had factored in, okay, well, things are not so good, et cetera. They'd already projected lower expectations to begin with. And then we come into earnings and they do even worse than the lower expectations. So it's like you're in school, your teacher thinks you're going to get a C and you get an F. It's just basically like, okay, yeah, this is not looking good. So I think we just literally got into the next leg of declines. How far it will go down, I have to say this is tough for me to say, but I'm not expecting a complete capitulation. But my thought process is that we'll probably see declining action in the market similar to what we saw back after the tech bubble burst. It wasn't, at first it was sudden for the NASDAQ, but for everything else, it was more a gradual decline that lasted for a while, for a while, for a while. Then finally things bottomed out. So we need to discover some reason for the economy to grow. That's what we need to find. And so far, we haven't found one. So I don't know if this is going to be a long-term type of recession, but I am 1,000% certain we now are clearly in recession, and it's just a matter of how far it will go.
Yeah, I think the big news will be how how high are the interest rates going to go at the next meeting, right?
Right.
And what the
Right.
verbiage is there. And from what I keep hearing and seeing, 3,800 on the S&P seems to be a very critical level that if we break, we could continue to go down.
Yep.
So with that, I think we'll be uh, closing the show out here. One quick note is if anyone watching, listening has a stock that they want us to go over, feel free to drop it and we'll try and bring it up on the show so that everyone can get a sense of the amazing analytics you can get from using the Medicine Trading House software. So if you have an idea and we run it through this analysis and it gives us input, you'll really start to see the power that you see here. At the same time, if you are enjoying the stream, feel free to hit that like, that follow, that subscribe button. We'll be providing more as the weeks go on. And with that, Mike, anything to look for through the end of the week?
I mean, as far as economics, we've got on Thursday, we've got Philly Fed manufacturing, unemployment, and existing home sales. Obviously, if those numbers come out poor, then that just basically means that things are looking worse. And the unfortunate thing is, whereas in the past the Fed would be more um, softer on interest, et cetera, that's not going to happen now. So it's basically a double whammy. If the numbers are bad, markets are going to sell because now they know the Fed's not going to intervene. So
Hey,
yeah,
look for those short positions, right?
yeah,
Because you
definitely.
you can make money up, down, sideways. You just
Definitely.
need to know what you're doing. So, uh, appreciate your time, Mike. Appreciate everybody tuning in. With that, we'll go ahead and close things out, and we'll catch everybody on the next episode.
Awesome. Take care, folks. Take care.